Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my good friend Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Welcome back, sir.
Thank you, Ivan. It's good to be back. Hello.
Yeah, it's always a pleasure having you come down to Wall Street Silver and speak to everyone. I just wanted to ask you, Mike, what the heck is going on in the world? You see everything that's going
Yeah.
on in the economy. You see, like it's just really scary. People are talking about inflation and comparing now to the Great Depression. So first, let's kick off with the recent Fed meeting that just happened with Powell. What do you think? What do you take from that?
Three words: higher for longer.
Yeah.
That's as simple as it gets. I don't think we need to do much more than that. I know it's significant. We have had some Fed governors come out and say, yes, the effects are early days. They probably haven't seen the full effects of the rate hikes, and that's mostly consensus. But as far as scary, I think the key thing to point out is we just a few months ago, the Fed, ECB, Bank of England were still hiking rates.
Right.
And typically, you can't compare this to anything really normal in history, but typically for risk assets to bottom, after recession starts, after that, a rate hike period like that, it usually takes almost a year.
Mm-hmm.
So I think we're in the early days of that tilt towards recession. Now we already have confirmed negative GDP growth in Europe. Now we pointed to that earlier with PMIs and services negative and negative retail sales. We have the property crisis in China continuing to be a problem, and I don't
Yeah.
think that's going to get any better. And then U.S. is just starting to do this tilt. We're starting to see the drawdown in payrolls, but that's so lagging. Like there's four key metrics I've been pointing out that are significant in this country, other than the inverted curve and leading indicators and Bloomberg economics all pointing to recession. The key ones are declining demand for diesel,
Right.
declining demand for gasoline, and the container board boxes all
Yeah.
declining. And it's so that's three, but um, it's early days. The key point is the Fed's finger is still on the tightening button. I don't know when or where it stops, but I think the bottom line is the stock market's still resilient, but it's a matter of time. I think everything starts to tilt and roll over. And crude oil's done that, copper's done that, silver's still pretty weak, corn has done that, all the grains, all the commodities with the exception of gold. The key question you have to ask yourself is what stops those trajectories? And the bottom line is the stock market remains resilient.
And we're watching that now really closely on what Fed and what Powell's doing next. How do you think it'll affect gold, silver, and the broader commodities market the second he does take a pause? Do you think it would immediate like what would you what results would you be hoping for if the Fed does pause or eventually pivot? What do you see happening to gold? What do you see happening to silver and the broader commodities?
Well, that's going to happen. There's one thing, and the metric I forgot to mention earlier was natural gas demand is also
Right.
declining. So I'll
Right.
finish that. But that's what the market's anticipating. If you look at Fed fund futures, it's already anticipating there's still a little bit of a hike price into the January meeting, and then by this time next year, the market's already priced for cuts, maybe up to 80 basis points. Now, the question is that going to happen? But those cuts have been, a year out for over a year. Remember at the
Mhm.
beginning of the year, that was supposed to be starting to cut by the end of this year. It's
Yeah.
not happening. And I think the key thing is um, risk assets, wealth. The wealth creation probably has to go down before the Fed starts cutting. The metrics they're watching remain sticky. Personal consumption expenditures, employment cost indices are still running around 4%. Core CPI still 4%, and their targets too. But to me, this is one of those gradually and then suddenly risks. And I'm still impressed the stock market's hanging in there. That's great. But I think it's going to take, like most people say, something to break. And people keep saying, well, you said that before and it hasn't happened. But it has happened in copper. It
Yeah.
has happened in industrial metals. The industrial metals index, Bloomberg Industrial Metals, is down almost 13% on the year.
Right.
And the key question you have to ask yourself is, why has it been delayed? And there's some really good reasons. And I think the bottom line that's really struck me in the last few months is that wealth effect, that wealth creation we created by pumping 42% of money supply to the peak from the end of 2019 to the peak in 2021 into the system, lifted all risk assets up about 42%. Now
Right.
money supply is starting to decline. from that end of 2019, it's up 34, 35%. Guess what's up exactly that amount? The
What?
Bloomberg Commodity Index, the S&P 500, and most real estate. The thing is, money supply is negative now. So I think what's happening is that biggest pump of liquidity in history is having some significant lagging effects, and it's starting to dump. And when it does hard, the key question is right now is we don't see anything to save it
Right.
from the Fed. And what's also been unique is this massive boost in fiscal stimulus this year, which has been offset by monetary restraint. And it's early days. I think I have been early, but crude oil did, put in a peak last year. It's running around
Yeah.
$77 a barrel. It's starting to show that global bent tilt towards demand destruction, which is always happens in commodities. And gold is one of the best performing major commodities this year, not bumped up again around 2000. It's driving everybody crazy. And as we speak on November 10th, it's 1936. That's basically the average price for the year is around 1,933 is the
Right.
average price for the year. And I think I mentioned this last time, Ivan.
Hmm.
That's the highest average price in the history of gold in terms of dollars. Now, in
Wow.
other currencies, it's all gone higher. So as far as the Fed, we'll get that tilt. And I'm afraid it's going to happen. The way it normally makes them to do is for risk assets to go down and make them start easing. But that's the key thing. They will never ease with the ease they have in the past because of the inflation created from creating too much liquidity last couple of years.
So I just wanted to let everyone know about our new sponsor, Strategic Wealth Preservation. They are an international precious metals dealer and they are a secured storage provider that have headquarters in the Cayman Islands. The company owns and operates a large Class 3 UL rated vault in the Grand Caymans, and they offer other strategic locations as part of its global storage network. They specialize in the acquisition, secure storage, and liquidation of precious metals for individuals, companies, trusts, and wealth management professionals on behalf of their clients. So if you guys want to check them out, the link is in the description below. And you mentioned a little bit earlier, those ever continuing real estate collapses in China. We've seen Evergrande at the beginning of the year, and in the recent weeks, we're seeing more major China real estate, companies go under. How will that affect the global economy? And what do you think China's doing? Like, they pumping liquidity to save those real estate companies, or what do you see happening there? How does it affect the global markets?
So I won't don't I try not to sound too redundant. I see China as some combination of what was described in the book Atlas Shrugged,
Yeah.
and what happened with peak Soviet Union and peak Japan about 30 years ago. The property crisis from Bloomberg Intelligence, as far as the amount of properties at risk of default, are close to 12% of GDP. And I look
Wow.
at just Evergrande and things like that, just trees in the forest. It's just there's not much they can do. Now as far as stimulus, that's kind of hard to measure. But if you see what their rates are, their two-note rate is around 2%, and the U.S. two-note rate is around 5%. That spread around 300 basis points is the highest since about 2006. So
Wow.
and that's also part of the wrecking ball problem. The U.S. rates are so high now compared to China, the second economy, compared to Japan and Germany, the number two and three economies, that the dollar is just so strong. But I see China as a very similar, and it's just overdue for some mean reversion. And the best catalyst you can ever think of is the war. Mr. President Z kind of cozying up to President Putin right before the war and pushing back in free market capitalism like we did with Jack Ma, like
Right.
he did with Jack Ma. So I view it as, I don't know what saves it. So we have the internal problems. We have the autocratic leadership. We all know what happens with that. The pushback on free market capitalism, the opposite of what Ding did when he came in. And its two best export customers, Europe and the US, significantly tilting towards recession on the back of very aggressive rate hikes.
Yeah.
So to me, that's what I look at is a great reset just getting started and significant deflationary forces kicking in. You can see that in natural gas. It's plunged, crude oil starting to collapse, copper starting to go down, industrial metals. And typically at this stage, Ivan, to have these things recover and do better, you need to have a decent lag to Fed easing. And they're only major country that's really been easing is China, partly because they have to. And I don't think it's going to help. There'll be bumps in the road, but to me, this is almost inevitable. We have to get through a lower plateau, get through this recession, and maybe recover organically.
Yeah, absolutely. And a lot of people online and on social media, they've been talking about, the actual debt servicing on the 33 trillion on that U.S. debt. How unsustainable is that, Mike? And like you said, we're going to eventually we're heading into a recession. With this debt servicing and with military expenditures and the interest alone on that debt, how unsustainable is this? Is like, where do we end up in the next 5 to 10 years?
So first, let's point out the facts of what's happened recently. The debt this year jumped up around 8%. Now it's dropped around 6, but
Mhm.
it's increased significantly, and really it's really picked up a lot since 2015. So there's been significantly diminishing returns. So a lot of the U.S. economy has been pumped up by low rates and increasing fiscal spending, deficit spending. So that's a train wreck to happen. But the lesson I've learned, Ivan, since starting in the bond trading pit in the Chicago Board of Trade bond futures in 1988 is every time someone says, oh, yields should go up and you should short bonds because the deficit's increasing, it's been wrong in the big
Yeah,
picture. We can look at Japan as a good example. We can look at 10-year note yields in Canada as an example. Why are they about almost 100 basis points less than the U.S.
yeah,
Because the U.S. has been hiking so aggressively. So yes, that's a problem. But here's what's going to happen, I think, is yes, there's a risk to that. That's part of the reason I'm still very bullish gold and still bullish things like Bitcoin, but that's another story. But we have this election coming up, and there might be a tilt towards austerity.
right,
Um, which would become at the absolute worst time. But that's to me is, yes, the deficit's a problem. But I look at it as that's why I'm very bearish the stock market and bullish things like gold. And I do think I am quite bullish treasuries in terms of yields declining for a typical recession. Japan's been able to do it. And that's the overwhelming force. Once you see risk assets start going down in deflationary forces, which have already shown this year, and the low for year-over-year PPI is minus 3.1%. Now
wow,
it's picked up again. That's producer price index. It's very volatile. Right now it's around 2%. You know
yeah,
what the high was in 2008? Up plus 9.9%. There's
wow,
it's more deflationary forces now than then in some cases. It's
that's
just so
crazy.
much more lagging. And then I look at the lagging effects of interest rates. But so the deficit situation clearly an issue, but this is like I said, the lessons I've learned having traded in debt and forever treasuries is that makes sense in most other countries. It hasn't made sense in Japan, and it's never really worked to get short and expect yields to go up, get short bonds when deficits spike. Although they're increasing quite a bit, quite a lot now.
Absolutely. Well, Mike, it's such a huge pleasure having you come down to Wall Street Silver. Like always, where can everyone reach you? Where can everyone contact you? Your social media?
So I'm on Twitter, Mike McGlone 11, and LinkedIn, Mike McGlone at Bloomberg Intelligence, and I'm happy to link in with people and add them to my distribution list. And Ivan, thanks for having me.
Yeah, no problem, Mike. We'll talk to you soon.